Don't list it. Let's just rent it out for a year and see how we all feel. That sentence gets said in kitchens all over San Francisco. About 6 weeks after a funeral, it sounds patient. It sounds respectful. And in San Francisco real estate, it is frequently the most expensive sentence spoken in the entire estate. CNBC published a piece this morning on inherited homes, and it's the best national reporting I've read on the sell, rent, or keep decision. But there are 3 San Francisco rules it doesn't cover because they don't exist anywhere else in the country. So here's what I'm going to show you. 1, there's a clock that starts the day the owner dies, and almost no family in San Francisco starts it on time. 2, of those 3 doors, sell, rent, or keep, one of them locks behind you here. I'll tell you which one and why at about this 9-minute mark. And 3, a 3-number test you can run at a kitchen table in 10 minutes with your brothers and sisters that settles this without anybody having to be the bad guy. 19 minutes if you're selling your home in San Francisco, or you inherited one and you're deciding this is the one. I'm David Poulsen, top San Francisco realtor and former real estate developer. What the national data actually says. Here's the scale of this. CNBC reports that in 2025, inherited homes made up almost 9% of all single-family residential and rural property transfers in the United States, a record. Cotality supplied that number, and the money behind it is enormous. Visa's July analysis put the baby boomer handoff at $36 trillion over the next 20 years. Cerulli Associates, using a wider definition, estimates north of $100 trillion through 2048. But the sentence in the article that stopped me was from certified financial planner Lazetta Rainey Braxton, who put it this way: it is like managing a business. That's exactly right. And it's part families get wrong. The day the owner passes, the house doesn't go to sleep. The property taxes keep running. The insurance keeps running. And in 2026, an unoccupied home is a different insurance conversation than an occupied one. The roof keeps aging. The Braxton family lived that. Her father wanted to buy out his 3 siblings. The conversation dragged, and by the time it resolved, the house had been demolished. That's the national frame. Now let me give you the San Francisco version, because ours is harder. San Francisco Rule 1, the clock starts at the date of death. Under federal law, when the owner dies, the home's cost basis resets to fair market value as of the date of death. That's a step up in basis. It is the single most valuable thing most heirs inherit, and most of them never see it. Here's why it matters more than almost anywhere. Take a Sunset District house bought in 1974 for $60,000. Today is worth up to $1.5 million. Under the old basis, a sale is a catastrophe with a step up. Your basis is the date of death value. If you sell near that value, the taxable gain can be close to nothing. So the clock, get a defensible date of death valuation in writing early. Estate attorneys will tell you the same thing. A formal appraisal ordered as of the date of death is the cleanest version. A broker opinion of value with real comparable sales is the working version. What is not defensible is a number somebody remembered 18 months later. And here's the part nobody says out loud. Every dollar the house appreciates after the date of death is potentially taxable gain. In a rising San Francisco housing market, waiting is not free. Waiting has tax costs, and it compounds quietly while everyone is being polite. If you're in the middle of this right now and you want a straight answer on specific property, call or text me at 415-735-6188 or DM me right here. No pitch. I do this constantly. Another beautiful foggy day here in San Francisco. This is our summer. San Francisco rule number 2. Proposition 19 and the 1-year door. This California only, and it's one that surprises out-of-state heirs the most. Before February 16, 2021, a child could inherit a parent's California property and keep the parent's old Proposition 13 tax base. Sometimes a 1978 tax base. Rental, second home, didn't matter. Proposition 19 ended that. Today, to keep the parent's low property tax base on the family home, the child has to move in and make it their primary residence within 1 year of the transfer and file for the homeowner's exemption. And even then, it's capped. The parent's factored base year value plus $1,044,586. That figure is set by the California Board of Equalization and applies to transfers from February 16, 2025 through February 15, 2027. So run it. Parents factored base year value on an inner Richmond home, $210,000. Market value today, $1.6 million. Add the cap to the base and you're roughly $1.25 million. The home is worth more than that, so the excess gets added on. You get a partial increase, not a full reassessment. Better than nothing and far better than the alternative. The alternative being if you rent it out instead of the family home, exclusion generally doesn't apply. The property gets reassessed to the current market value on that same house. You're going from a tax bill in the low thousands to a tax bill in the high teens every year forever, which is why let's just rent it for a year and see how we feel is such an expensive sentence. In most cases, the year you spend deciding is the year the exclusion expires. San Francisco Rule 3. The door that locks. Here's the loop I promised you. Sell, rent, keep. Both of those doors swing both ways. One of them locks. In San Francisco, the moment you place a tenant in that inherited property, you've changed what you own. most residential buildings here with a certificate of occupancy issued before June 13th, 19 fall under San Francisco Rent Ordinance. Single-family homes and condos get some relief on rent increases, but under state law. But San Francisco's just cause eviction protection still reaches the great majority of tenancies. Getting a property back vacant later is not a decision, it's a process. Owner move-in, Ellis Act, a negotiated buyout under Section 37.9E. Months, lawyers, disclosure, real money. I have clients that are living through this, and it's an emotional process and takes time. So the honest framing in this, renting an inherited San Francisco home isn't the cautious middle option. It's the most irreversible of the three. The developer's eye. 30 years ago, I was subdividing raw land, building out tracts up to 48 homes. Here's the lens that gives you applied to an inherited house. Developers don't price a property. They price the condition of the rights attached to it. Same dirt, same square footage. Entitled versus unentitled is a completely different number. An inherited San Francisco home works the same way. And the entitlement is vacant possession. A vacant single-family home in the Sunset or the Richmond sells to the deepest buyer pool in the city. Owner-occupants, emotional buyers, people writing over asking because they're going to live there. A tenant-occupied version of that identical house sells to investors running a cap rate, and it trades at a discount depending upon the tenancy. I've seen that spread run anywhere from 10 to 25% of value in San Francisco, sometimes more. So here's the developer's eye rule, and I want you to write it down. Vacant possession is the most valuable and the most perishable thing you inherited. It has no line item. It doesn't appear in any statement. And you can spend it in an afternoon by handing someone the key. That doesn't mean sell. It means know the number you're giving up before you give it up. If the rental income genuinely serves the family, fine. Go in with your eyes open. Price the option you're spending. What I don't want is a family finding out about that spread 18 months later from me in a listing appointment. The 3-number kitchen table test. Now, the practical part, siblings usually don't disagree about the house. They disagree because they're each holding a different number in their head, and nobody has written them down. So write down 3. Number 1, the true annual carry. Property taxes at the assessed value, not the parents. Insurance on the current occupancy status. Maintenance at 1 to 4% of the value a year, which in San Francisco is real money. Utilities. Any mortgage. That's the cost of keeping it, and it's paid monthly starting now by somebody. Number 2, the net sheet today. What the home actually nets after transfer tax, commission, and any pre-sale work, measured against the date of death value. I'll build this for you for free, and I'll show you which repairs return more than they cost and which ones don't. Number 3, the vacancy spread. What the property is worth, vacant versus tenant occupied. That's the option you're spending if anyone says, let's just rent it. Then add one thing CNBC's advisors got exactly right: a deadline. Braxton recommends building a clause into the estate plan giving the trustee authority to sell if there's no decision in 6 months or a year. If you're past that point, there's no clause. Set your own. Pick a date. Put it on the calendar. Grief plus no deadline is how the house gets demolished. And if the parents are still living, that's the conversation to have this year, not later. Every advisor in the article said the same thing, and the estate attorneys added one more. A trust only protects what's actually titled into it. Verify the deed. One real family. I sold a house in the Excelsior for a nephew who lived in Atlanta. 50 years of one owner. Orange counters, green shag, and under the shag, original hardwood and beautiful fireplace tile nobody had seen since the 60s. We cleared it out, spent about $20,000 on the right things, staged it, and it sold with multiple offers. He never flew out once. He had a decision framework and a person on the ground, and that was enough. That's all this is. Quick and important. This video is for education and entertainment purposes only. It is not legal, tax, or financial advice. Proposition 19, the step-up basis in the San Francisco Rent Ordinance are technical and the mistakes are expensive and permanent. Please consult a CPA, an attorney, and or a financial advisor before you act. I'm David Poulsen, top San Francisco realtor. My family has lived in the San Francisco Bay Area for 4 generations. And I've personally spent over 30 years in real estate navigating this area's unique market cycles. And hundreds of homes sold. If you inherited a home in San Francisco, or you're the one in the family who ended up holding this, call or text me at 415-735-6188. Or email me at david@sfhothomes.com. Or just DM me here at YouTube. I answer all the questions and would be happy to talk to you. I'll build you the net sheet. No cost, no pressure. Links in the description. And if you do have a chance, a lot of you watch but still haven't subscribed, please hit the subscribe button. If you love this video or want more information, also hit the like button for me. All right. Take care, everyone. This is David Poulsen coming to you live here in San Francisco's Pacific Heights. Bye-bye.